Most people think the stock market is a scoreboard. I think that is one of the costliest misunderstandings in modern investing. What looks like a market is often just a machine moving money from one square to another, while the crowd stares at the wrong square. The public thinks money disappears. It usually does not. It rotates. It leaves the loud. It leaves the names everybody can recite at dinner. Then it walks quietly into places most investors have never bothered to study. By the time the headlines catch up, the easy money has already been made. I learned a long time ago that the market does not reward attention. It rewards correct attention. Those are very different things. Right now, the average investor thinks he is diversified because he owns an index fund and a few famous technology names. He thinks he owns the market. In truth, he often owns a concentration disguised as prudence. He owns a system that keeps pushing more and more capital into the largest companies, simply because they are already the largest companies. The richer square on the chessboard keeps receiving more pieces, more support, more automatic buying, and the investor calls that safety. It is not always safety. Sometimes it is just momentum wearing a respectable suit. The first thing you have to understand is that a cap-weighted index is not neutral. It has a bias. The bigger a company becomes, the more of your new money it receives automatically. That means passive investing does not merely measure leadership. It reinforces leadership. It becomes a flywheel. A company goes up, its weight rises, more index money buys it, and then its weight rises again. If the weather is kind, this feels brilliant. If leadership changes, many people discover too late that they did not own 500 businesses. They owned a narrow group of giants and a long tail. They never really studied. I call this the size magnet. The size magnet is powerful because it lets investors feel rational without doing much thinking. They can point to low fees, they can point to convenience, they can point to long-term returns. What they cannot point to is an understanding of where fresh capital is actually going. Now, that is where the gap opens. That is where disciplined investors separate from spectators. I have never made my best decisions by asking, what is popular? I ask where the economic force is building, which square on the chessboard is about to receive more money, more urgency, more necessity, more political support, more supply scarcity, more pricing power. When you learn to ask that question, the market becomes less mysterious. Not easy, never easy, but less mysterious. Most investors get trapped because they begin with the stock. That is backwards. They wake up and stare at the same 10 names, the same flashy charts, the same noise. They ask whether one giant company will beat another giant company by 3% next quarter. That is the wrong battlefield. The right battlefield is higher up. It is the movement of money between sectors. It is the migration of capital from crowded squares to neglected squares. It is not who wins inside a hot trade. It is what trade becomes hot before the public notices. I call that the rotation gap. The rotation gap is where money gets made in markets that no longer lift everything together. In easy years, almost any square on the board can advance and make you feel intelligent. In a harder era, selection matters. Not just stock selection, sector selection, theme selection, sequence selection. You do not need to predict the weather perfectly. You need to stop dressing for last season. That leads to the second thing most people miss. They think macro means prediction. I think macro is often just weather recognition. I do not need to know the exact path of rates, inflation, elections, wars, or central banks to know that the world needs more energy, more grid capacity, more industrial inputs, more strategic redundancy, and more domestic supply in things nations no longer want to import from fragile places. I do not need to know the perfect quarter when that spending peaks. I only need to see that the pressure is building, and when pressure builds, capital eventually follows. That is how you stop behaving like a gambler and start behaving like an allocator. When I look at this environment, I do not begin with the brightest stories. I begin with necessity. The world is trying to electrify more of itself while demanding more data, more computing, more redundancy, more defense, and more control over the pipelines of modern life. That means the obvious winners are not always the glamorous companies talking about the future. Sometimes the better businesses are the ones selling the pipes. The tools, the compressors, the services, the ground equipment, the process infrastructure, the boring pieces without which the future does not arrive. I call this the shovel rule. In every rush, somebody wants to own the dream. I would rather understand who gets paid whether the dream arrives a little early or a little late. In energy, that often means the service and infrastructure businesses that benefit when drilling expands, when liquefied natural gas capacity grows, when offshore equipment is required, when existing fields need maintenance, and when geopolitical disorder forces nations to spend more on secure supply. In minerals, it often means the producers and process chains behind lithium, uranium, rare earths, and other inputs that sit underneath batteries, grid upgrades, defense systems, and data center power demand. The crowd wants a miracle stock. I want an economic toll booth. That is why two parts of the board deserve more attention than they are getting. The first is energy equipment, services, and related infrastructure. The second is critical minerals and strategic material supply. Neither square is exciting to most retail investors until price forces them to care. That indifference is useful. Indifference is cheaper than excitement. Take the first square. People hear energy and think oil price. That is too shallow. The more important question is what happens when the world needs more extraction, more transport capacity, more field services, more LNG build-out, more repair work, more resilience, and more replacement of vulnerable infrastructure. Those conditions do not only help the commodity, they often help the companies selling the equipment, expertise, and operational machinery that make the commodity system function at scale. A business like Baker Hughes exists in that zone. I am not saying a ticker is magic. No ticker is magic. I am saying the category matters. If more drilling, more gas infrastructure, more offshore development, and more equipment intensity are coming, then the companies occupying that layer of the chain deserve attention. A smaller player like NPK sits in a different part of the same ecosystem. The names are less important than the logic. The logic is that when the world is forced to spend on hard systems, picks and shovels can outperform the dream merchants. Now take the second square. Critical minerals sound abstract until you list what consumes them: electric vehicles, battery storage, grid modernization, defense systems, electronics, cooling, transmission, data centers, nuclear fuel chains. Countries can pretend supply does not matter until supply becomes geopolitical. Then suddenly it matters a great deal. I call this the scarcity corridor. A scarcity corridor appears when demand rises for something that is politically sensitive, operationally difficult, capital-intensive, and time-consuming to expand. By the time the public recognizes the shortage, the relevant equities have often moved already. A lithium producer such as SQM, a uranium-linked name such as UEC, or a rare earth exposure such as CMP may not move in a straight line, but they sit much closer to the corridor than the average investor realizes. Again, I am not handing you a shopping list. I am showing you where the board is being reweighted by necessity. The temptation here is to hear a story and buy instantly. That is where discipline must arrive. I do not believe in worshiping tips. Tips are for people who want borrowed conviction. Borrowed conviction vanishes the moment price moves against you. What I want is a process. A process lets you stay rational when the screen becomes emotional. My process is simple enough to explain and hard enough to practice. First, identify the weather, not every detail, just the force. Where is pressure building in the real economy? Where is spending likely to increase? Where is scarcity likely to matter? Where are politics and capital likely to align? You do not need 20 indicators. You need clarity. Second, rank the squares. Which sectors are actually attracting money? Which themes are moving from ignored to funded? Which groups are building relative strength while the public remains distracted by the famous names? This is where many investors fail because they try to jump from narrative to stock without checking whether capital agrees with the narrative. Third, select leaders inside the winning square. Only then do you earn the right to look at the individual business. And even there, I do not want a company simply because it exists in the right neighborhood. I want a leader. I want the stock institutions are willing to support. I want the one proving itself relative to peers. I want strength with confirmation, not hope with a slogan. I call this the confirmation gate. Most people think buying lower is smarter because it sounds prudent. Sometimes it is prudent. Often it is just ego disguised as thrift. In markets, the cheapest entry is not always the safest entry. Buying before a business or stock proves itself can trap you in dead money or worse, in a value illusion. I would rather overpay a little for confirmation than underpay for uncertainty and discover I was early, wrong, or both. The public hates that idea. Because the public likes bargains more than evidence, Wall Street likes evidence. When a stock moves sideways for a while, builds a base, absorbs selling, and then breaks above a meaningful prior high with support, it is often telling you something important. It is telling you demand is now stronger than supply at a visible level. It is telling you capital is voting. I never mistake that vote for certainty, but I respect it far more than opinions shouted from a screen that said, none of this matters without the final mechanism, risk. I call it the risk budget. A good idea without a risk budget is just a prettier way to lose money. Every position should be sized so that being wrong is survivable. The average person is not ruined by one bad thesis. He is ruined by size. He falls in love with a story, confuses interest with understanding, and makes a position so large that volatility becomes destiny. Then he panics at the first drawdown and blames the market for a mistake he designed himself. I have no interest in that game. If I want exposure to a new square on the board, I can do it with a modest position. I can scale in, I can diversify within a theme. I can use an index fund if I want broader exposure rather than an individual stock, if I do not yet trust my judgment enough. There is no shame in using the simpler vehicle. The shame lies in pretending you understand what you do not understand. Humility is cheaper than tuition. The deeper truth is that the board never stops changing. One quarter it is defense, then insurers, then electronic components, then energy services, then miners, then healthcare. Money does not marry a square, it moves. If you want to outperform in a world where everything is not going up together, you must be willing to move your attention where the capital is moving, not frantically, not emotionally, methodically. That is what I mean when I say follow the money. It does not mean chase every candle. It means understand that price is often the surface evidence of a deeper migration. Money flows from crowded to uncrowded, from expensive to neglected, from mature momentum to fresh necessity. If you can learn to see that before the crowd celebrates it, you do not need to gamble. You simply need to be earlier, more disciplined, and less distracted than the average participant. Most people spend 40 or 50 hours a week earning money and almost no time learning how money itself moves. Then they hand their future to default settings, stale narratives, and famous names. I think that is too passive for a serious adult. You do not need to become a full-time trader. I have never recommended that to ordinary people. But you do need a framework. An hour a week of clear thinking can save years of wandering. So here is the test I would give you. Do not ask which hot stock the internet loves this week. Ask which square on the chessboard is receiving new force from the real world. Ask where the passive crowd is overconcentrated. Ask where the neglected necessity is quietly becoming impossible to ignore. Ask whether you are buying a story or a flow of capital. Ask whether you have a confirmation gate. Ask whether you have a risk budget. Ask whether you are trying to look clever or trying to compound. If you can answer those questions honestly, you will already be thinking better than most investors. The market will always tempt you to stare at the loudest square. Resist that temptation. Wealth is often built by understanding the movement before the applause. The rich do not always see more than you. They often just understand the board earlier. And if you remember only one thing, remember this. Money is not standing still. It is moving from square to square every week, every month, every quarter. The investor who learns to read that movement is no longer trapped inside the index flywheel, no longer hypnotized by celebrity tickers, no longer forced to wait for television to explain what already happened. He is finally playing the game that is actually being played. That is when the market stops feeling random. That is when you stop being the product of the machine and start becoming its beneficiary.